Hi, you're watching Russell Market Week in Review for the week ending March 20th, 2015. I'm Mark Soupiset, and we're coming to you today from Russell's world headquarters here in Seattle, Washington. I'm joined by Adam Goff. Adam, good morning. Thanks for being with me.
Morning, Mark.
Appreciate your time today and your insights. Okay, so the big news of the week, I thought, was certainly here in the U.S., where the U.S. Federal Reserve Chairman Janet Yellen came out with a statement, and I think there was some, what I heard, maybe some changes to their outlook that got the attention of the markets. What's your general take on that, and are they really changing positions or not?
Well, it certainly got the attention of the market. We saw some pretty dramatic moves in the dollar, and the markets were generally positive afterwards. But I mean, the big headlines were kind of as expected. Nothing was done to rates. There wasn't really much sense that anything was going to happen there. And there was a changing of some very significant language in the Fed statement, which is sort of the way that Yellen and the Fed board sort of signals to the market how they're feeling, which was moving from saying they'll be patient about raising rates to removing that language, to no mention of patient. Now, the important thing was she coupled that statement of we don't need to be patient by saying we're also not going to be impatient and trying to balance out the message.
They're patiently impatient.
But you're right, under the surface there was a lot going on, and there were a lot of adjustments of outlook, which we think are significant and are what the market's been reacting to.
What really stood out to you then from that? I mean, as you looked at what was underlying that statement, what are they looking at to say, you know what, we feel like there's some slack maybe?
Well, yeah, I think that's the first key point, is that the reason that they're not impatient is, and this came through on the individual the Fed board members' sort of outlooks for the economy, is that they do feel there is slack. I mean, one of the key measures of that is where they start to think unemployment or unemployment levels are reaching a level of full employment. They revised that number down from a number which touched on the 5.5% that we're at now to something closer to 5%, which says we still have a ways to go before we think the labor market's tightening. A second point, which I think something a lot of folks were wondering about, was they acknowledged the importance of the movements in the dollar and the downstream impacts on the economy in a couple of ways. First of all, they noted that exports have been slowing, and that has moderated their outlook for growth. They've also noted that cheaper imports coming into the country has an effect of lowering, along with lower energy prices, of lowering the outlook for inflation. And altogether, that really, I think, sort of the biggest development is their outlook for growth, their outlook for inflation's moderated. This is why they're not feeling impatient. And as expressed in what are called the vaunted dot points, the Fed board members are indicating that they expect a less precipitous rise in rates after the first rate rise. Everyone's focused on this first rate rise, and it is very important, but really one of the big things the market's been focusing on is how differently the Fed seem to be thinking about the subsequent rises in rates as what the market's been pricing in. And we saw in that moderation of expectations a bit of the closing of that gap. And I think what you've been seeing in the market, although the reaction in the dollar has been all over the place, and I think we'll see more of that going forward. It's generally been a little bit of a closing of that gap.
Okay. We'll certainly keep an eye on that, and the timing in particular is going to be fascinating now to see, does this slip later than we thought, or does it happen in the fall or later?
Yeah, I mean, the importance of these sorts of meetings, and this was a particularly important meeting because there was the press conference afterwards, is just to read where Yellen and the Fed's sensitivities are. I mean, when we think about the perfect mix of elements to keep the market going up while the economy is also strong, you talk about the Goldilocks economy or the Goldilocks market. I mean, really what Yellen is the person that we most need to listen to in terms of what the actual temperature of the porridge is at any moment in time. And what she came across with was not too hot, not too cold at this point, and so that's why the equity markets were generally positive, if not explosively so.
It doesn't matter what you and I think the porridge temperature is, it's what she thinks.
And we definitely got some information on that front.
Let's wrap up in Europe then, where we saw pretty strong movements in the market, positive movements in the markets this week. Mario Draghi came out and said an economic recovery appears to be underway. This seems to bolster or at least support what we've been saying, I think, for a while about European equities, does it not?
Yeah, we've always seen the upside. We've seen the upside potential in earnings from a fairly low base. Certainly we saw the makings of a recovery in the economy, and we thought, given the upside in earnings and the low margins they were starting from, that this should be a positive for equity markets. And boy, has it been. I mean, the European markets are up nearly 20%, and We think there's more to go. I mean, the ECB just started buying bonds back. One of the nice bits of anecdotal news from the economy this week was that European car sales were up 7% across all of the major economies. Some of that was driven by some special incentive programs in Spain, but you look at Germany, France, Italy, all of them saw growth. This is an economy which is coming alive, and although that hasn't affected outlook for inflation or people dramatically raising their growth you see it feeding into other expectations. Just last week, the OECD revised up their expectations for global growth from what they were saying was 1.1% in November is now 1.4% going forward. And a lot of that's coming from perceptions that the European growth engine may be coming alive. We're still optimistic about Europe, but obviously we've seen a lot of the benefits already.
All right, Adam Goff, good stuff. Thanks so much for being with
you.
us this week, and thank you for joining us on Russell Market Week in Review. We'll see you next week.